Welcome everybody to a investor update for Tri-City Equity Group and Black Sand Property Management. This is going to go over the state of the DFW multifamily market, and we're going to go over our portfolio, what we're seeing in the market, and how we're positioning ourselves to take advantage in 2026 and 2027. So getting started here. All right, for executive summary, the DFW market has had 42 months of consecutive distress. That's going to be through low occupancy, high concessions, oversupply. That's kind of positioned what we've been navigating through for the last several years. We're going to go over portfolio performance. The Tri-City portfolio ran by Black Sand Property Management has been operating at or above DFW benchmarks despite this pressure. And the operational response going forward is continuing to recover. We are now actively seeking to deploy capital into a generational basis reset window. Dee's going to talk about that later on. And what we're targeting is distressed assets. Okay, where we are in the cycle. So like I mentioned, 42 months of consecutive distress in the DFW multifamily market. This is coming straight from industry reports. A lot of our brokers will send them, and we do our own research as well. So CBRE, Berkadia, Marcus Millichap, Colliers all produce DFW market outlook reports. We do our own research as well as some of the subscriptions we have through CoStar and ALN. We pull this data from. One of the points over here is how the market is starting to pick up. We met with one broker, and his Q1 activity was 330 broker opinions of value, so broker appraisals for Q1. And that is more than he did all of last year combined. He did just of Q1 this year, and that's just one broker in the DFW market. And we met with 6 or 7 brokers over the last couple of weeks, and they all had very similar stories that there's this pipeline building that is going to start coming out throughout this year, next year. Okay.
Yeah. Hey, Vince. Oh, good. Vince, I was just going to ask, when you say that we're going to be targeting distressed properties, just explain what do you consider a distressed property? Like, what's the definition of that?
Most of the distressed assets we're seeing are from people that have had floating rate bridge loans or high leverage loans that are coming due. So they bought at the most common story we're hearing every week is they purchased in 2021, 22, 23 with floating rate bridge debt with the bet that the interest rates can't stay high for this long. And they did. And they're at a point now where the lenders are either, calling those notes due. They're making them do by rate caps, which when we're talking 10, 20, $30 million deals, those rate caps are millions of dollars to buy down the rate in order to keep the loan, or they've already done a workout plan with the lender last year, and the lenders just they can't afford on the lender side to continue to hold that non-performing note. So they're being forced to sell, and they're either being forced to sell because on the seller side, as the owner still has the property. And that's what we were seeing a lot of last year. This year is completely different. The forced sales are actually after the lender has taken back possession. Most of the properties we're seeing now, the lender has already taken back possession of this property, and they have it with the receivership or the servicer as appointed a property manager. And the conversations we have now, most of them are with the lender directly. I would say probably 4 out of the 5 conversations we've had in the last couple months have been with the lender directly as sitting in the seller's seat. And I don't know, Dee, if you want to add anything on that.
Yeah, no, I got a lot to talk. I'll save it as once we get down there. But one of the points I will bring up now is that in the DFW market right now, all those BOVs, that's just one broker. I think that's Marcus Millichap. So there's 330 BOVs that they provided or have completed. There's 17,000 apartment complexes in the DFW market, and there's a third a third of those um, is under a 1.0 DSCR, meaning that they cannot cover their total expenses. So a third of assets across the DFW market are distressed. That's what we talk about, distressed assets too as well, and opportunity.
Wow.
But we'll talk more too as well.
So basically, we're going after. I mean, one man's loss is another man's gain, I guess, so to
Yep.
speak. We're getting like these properties that we're looking at now are probably 20-30% below what they sold for back in just 2021 or 2022. And you feel like, I mean, with this type of deep discount like that, we're going to be in an amazing position in the near
Yep.
future.
Yep. Yep. And I'll explain a little bit more since we're talking about it now. So what's happening, where the last time we seen this cycle was 2008. All right, this is the last time we seen this cycle. DFW, we came in the market, we came in a few years ago, several years ago, we came in and we have been purchasing kind of at the top of the market, and we have been coming down as prices continue to come down. Where we at is kind of like, well, down at the bottom, all right, where we are seeing tons of properties based off a cost basis, meaning when it last traded. Just give you an example, give you some context on. For example, the last property we closed on was about $9 million discount, $8 million discount. And that 30% discount what Vince was talking about, and this is for Class A product. We're saying more 30% discount on Class A properties because the sponsor is losing the equity, which is the investor's capital. All right. And which I got to point out later, which I'm proud that we have not lost any investors' capital. We've been performing great. And the second piece that we want to talk about is when we talk about 50%, we have seen it all the way to 70%. And that's going to be more so your C-class assets. And what we're seeing with C-class assets are what Vince mentioned are the foreclosures and bank owned, where the banks are taking them back. So now what you're seeing is you're seeing the deal is $30 million. All right, $8 million. So the note is $22 million. The lender is walking away and losing another $5, $6, $7 million on the available balance of the loan. And that's how we are seeing 50 to 70% discounts from when it last traded based off the cost basis. So we're going to run two paths, and I'm just going to talk to the lawyer. We focus on two paths. Path number one is going back to our C-class. That's how Tri-City was invented. You know what I'm saying? That's our bread and butter. C-class, we know how to do it. We had a 32, 33% IRR on average with a 2.5 year hold time. And we're going to be focused on two paths. Class A, that's going to be our legacy properties, which is going to be 30% discount, where we're seeing things that was traded for $240,000 a door are selling around $190 a door, or right at below $200,000 a door. And we seeing the Class C assets that was traded $150,000 all the way down to $70. And me and Vince also are working on deals at $50,000 a door that last sold at $100, $110, $120,000 a door. So that's what we're talking about. That's what we're focused on.
Wow, that's incredible. It looks like these are a good opportunity coming up for us in the future.
Yeah,
so that's pretty exciting.
It's a perfect timing to be in the market. Again, the last time we seen these was 2008. And those that's listening and watching in this tuning in right now, this is opportunity that doesn't come. Market cycles, we have business market cycles, we have real estate market cycle, and after COVID, everybody knows that the house, what your house value probably double or increased about 50%. That was the high peak of the market. Now we coming down, and what you're not probably seeing if you're watching it, what you're seeing behind the scenes are all the distressed assets that Vince talking about with those BOVs, where you have one office doing 330 BOVs, and we working with 12, 15 brokers, the main brokers out in DFW. So if they're doing 330, I'm pretty sure everybody else is averaging 250, 300 BOVs as well per office, and they're seeing those same discounts and those same distressed assets.
Wow. So the other thing probably to mention is most of these people who own these are out-of-state owners who don't care about their assets, and they're not vertically integrated like we are, so that they're not managing their own properties. So their property managers don't care. Their occupancy is horrible. Their tenant base is horrible. So they put themselves into a real bad situation versus us, where we're managing our own with great tenants, great occupancy, and that's really, I think, the difference between us and other people.
Yep.
Nice.
Absolutely. One of the brokers that we talked to, he's been he's nearing retirement age, and his comment was, in 48 years of being a broker, he hasn't seen this level of distress in the commercial market, even in COVID, even in 2008, 2009, even in there was another one in around 99, 2000 as well. Or the 90s was a big one, the bank bust here in the 90s in DFW. So this is unprecedented level of distress in the multifamily here in Texas. Three drivers. I already mentioned the one. Floating rate debt maturities. All the people that bet on the rates have to come down. That was a big news story in 22, 23 and this was at all industries, not just commercial multifamily, but just at the macro level. There was a large voice out there, talking about that the rates can't stay this high this long. We can't service our, national debt, all these things, the market would crumble. And here we are, 3-4 years later, rates are still high. So all the people that bet on the rates have to come down, they did so with floating rate bridge debt. And now those loans are coming due because they're shorter term loans, and they didn't have a plan B, and they don't have the capital to inject in order to stabilize the asset with permanent debt or fixed rate debt. So that is kind of the first bunch of that third of multifamily that is in distress. The equity wipeouts, that's a lot of what we're seeing. And a lot of that equity wipeouts is they overpaid for a lot of assets. They leveraged them up pretty high. We're talking 80% leverage. And then when the market recedes, 10-15% on revenue, which is where we're at now, we're about 10 to 15% decline in rents, as well as an increase in expenses of a big one here in Texas has been taxes, insurance, and payroll has been really ballooning up the last few years. So that erosion of NOI, because they're high leveraged and their cost basis was so high, they couldn't absorb that. So they're getting completely wiped out. Okay. And then the third bucket is just retired and burnout owners. They've had enough. They've tried to stick it out, weather the storm, and they're just done. They want to get out. They want to get out of the market. Okay. And that's mostly what we're seeing, of where the product coming to market is coming from. Okay. This was one thing that I thought was very, very interesting, because we've been hearing this distressed story for the last year and a half, but we haven't been flooded with a lot of inventory, like actual to buy, like it's kind of trickling out. We did sit down with a very senior broker at one of these firms a couple of weeks ago, and he kind of explained how these distressed assets will sit on these CMBS pools and things like that, and not get forced sold because the lender doesn't want to deal with the debt or the management. And essentially it comes out down to, when you have securitized loans, like a lot of commercial multifamily securitized on Wall Street, they get put into a bond pool, and the person holding that, buys those bonds or in those bond pools has like certain voting rights and things like that of being in that bond pool. And if they lose and if they get rid of those notes, those non-performing notes, or wipe those debts, then they lose their positioning on Wall Street in those bond pools. And I might, for those that are listening that know what I'm talking about, I'm sorry if I butchered that, but that's how I understood it. Is they'd rather keep a non-performing note on their books and write it off strategically over time, whenever it's optimistic or when it benefits them strategically, rather than force sell and get rid of all these notes and lose their positioning and their voting rights in these bond pools on Wall Street. So that's why we're not seeing a flood of multifamily, even though we can see in our reports that these distressed assets are there. We can pull a CoStar and I can look at every single owner and see who's on a watch list, see who's already been foreclosed or pre-foreclosure, but the properties aren't transacting. It's because they're holding them and kind of trickling them out over time so they don't lose whatever positions or ratings they have on Wall Street. So I thought that was very interesting piece of information. The closest analogy that this broker brought to us was the mall, like shopping malls. He's like, that was kind of like the last thing that was remotely similar to this. Obviously, there's not as many malls as there is multifamily, but as far as like how this distressed assets are playing out through the market, it's a lot like the malls in like the early 2000s, how they all and currently how they're all kind of closing up and they're not transacting. They're just sitting there vacant because the note holder doesn't want to write that loss off on their books just yet. Okay. So what the implication of that is that we're going to see this trickle out over the next couple of years versus a big flood of distressed properties, and then it's going to be all over. They're going to trickle them out over a year or two.
So on our existing ones, I guess the reason why we're not getting crushed is because one, we have good debt. Two, we put a tremendous amount of money down. And three, we're much better operators. So we actually have people in there that are good tenants and they're paying their bills. Does that sum it up pretty well, like why we're not in this scenario?
Yeah, absolutely.
Yep. Go ahead.
Yep. No, as far as I think one of the biggest things that we did when we shifted and came into the DFW market and we decided to go a mile deep versus a mile wide, we also positioned ourselves and decided to make sure we go after good debt, number one, right? So when we think of good debt in this cycle, good debt in this cycle is fixed rates, 5 years, 7 years, agency debt, and the LTV, loan to value, somewhere between 60 and 65%. Now, for us, we're at 62% loan to value, meaning that our portfolio have about 40%, so every $100 million, you got to say we got over $100 million. So we got about, let's say $40 million almost of equity on $100 million of assets that we currently have, which give us the opportunity where we say sleep better than most at night, because that help us with our occupancy can be much lower than someone. In fact, everybody that we're talking about right now are the people that did not finance right. That's the reason they're in this position. They are being forced to sell, and they're being forced to sell because they had short-term debt, where that a lot of bridge debt, where that the terms are 2 years, 3 years, and the debt has been showing of expired. One of the things that we hear too as well, when I was back in January, I went out to the multifamily conference, which is the largest multifamily conference in the world, NMHC. And at one point, the lenders was working with the sponsors where they'll give 12 months or whatever. Right now, those times are gone. That's why we're seeing more REO, which is those bank-owned properties. But yes, that is correct. We are vertically integrated with Black Sands, our own property management company. I'll talk a little bit about that later. But I think those are the two most important things is that let's just be real. No one's going to care about your property and manage your property better than you. And at this point in time where we at right now, I couldn't think of a better position for us to be in by managing our own property and looking at our debt or our balance sheet, where that we are 62% LTV. Our last deal we raised, I think, what was the colleges was what? Was it 70, 65%?
Mm-hmm.
And then the deal Wine Away was 50%, almost 50%, 55% LTV. So we position ourselves well for this market, and and another thing, we don't have our back against the wall, or no pressure from lenders say y'all guys have to sell, y'all need to make a move. With all of that's because on the front end we make sure that we We finance right, and we have non-recourse debt too as well. And one thing to mention too, I believe all of our properties in our portfolio, except for two, are all agency. That means Freddie, Fannie, and HUD, where that, much better terms. It's government, and, super long term, better debt, better pricing, and things like that. So.
Yep, absolutely. Long-term fixed rate, non-recourse debt with low leverage. We finance right. That gives us the patience and ability to weather storms, like we're seeing here in DFW. It's a quick snapshot of the market performance. Is industry market-wide. And again, this first slide's across all classes, but we're at a 90% stabilized occupancy. This is DFW, not Black Sand. DFW is at a 90% occupancy, which is down 3.4% year over year. Stabilized effective rent is $1,450, which is down 3.4 year over year. And 50% of all multifamily in DFW is giving a concession, with the average being 8 weeks of free rent, is what most properties are giving, or half the properties are giving up to 8 weeks of free rent.
What else are you seeing? What else we seeing? How much money? What's the biggest ticket?
Yeah, so one of our competitors is offering up to $5,000 of free rent just to get people to move in. And this is a brand new asset, A-class in lease up, and they're already struggling to stabilize a brand new A-class asset. So they're resorting to go up to $5,000 of free rent just to get people to move in.
Man, they are setting themselves up for failure, because they're probably moving in non-qualified renters. They're giving them $5,000 worth of free rent, and then the people probably can't pay it, and then they got to foreclose on it, or basically try to evict them. So that is just the worst. That's the worst way to do business.
And that strategy you see with third party, which is one of the biggest things that we see. A common theme about all of the properties we're seeing is the third party property managers they're not being good stewards of the property. A lot of them are absent, and they're not there, and they're not telling truthful stories to the owners about what's actually happening at the property. And if the owners are out of state, and they don't live in the market like me and John, who live here in DFW, and we drive by the properties all day, or every day we're at one of the properties. The owners aren't seeing, what's actually happening, and they're getting sugar-coated reports and skewed stories about what's actually happening on the property. And they do that until it's too late. And there's no, they reach a point of no return on operations. And we're seeing a lot of that. Here's a quick snapshot still on DFW as a metro about what each class's effective rent is by class. Okay. And then which ones are offering concessions by a percentage. So 42% of B class are offering a concession, 52.9% of C class, and 60% of D class is offering concession. I skipped A class. 33% of A classes are offering a concession. No, we don't have any D class properties, so we don't have to worry about that one. All right. So how is Black Sand doing? So this first report here is our Black Sand and Tri-City portfolio occupancy versus the submarket that it's in. Okay. So first one is Kings Landing and Mansfield. We're at 84% current, with the 91 is the average. This one is not a market issue. This was a property manager and this is Q1 only, this is not year over year or anything. This is just Q1 performance for this year. We did have a property manager that had a significant life event, and it caused her to kind of lose track of her property. We have since replaced her with somebody new, and we'll get that property back up. Kings Landing is normally one of our best performing properties. So this 84 is not a market issue. This is a personnel issue that we have already identified and corrected. Little Creek and Cedar Hill.
And real quick, Vince, I think it's important to mention, as far as Kings Landing, when we talk about C class and A class, and like, you want to talk about a little bit about?
I have it on the next. I have that on the next slide.
Okay.
Yep.
All right.
So Little Creek, we're at 87. We're meeting the market. Cottages, this is Hearst, is our latest acquisition. We're beating market occupancy. Winding Way, we're at 78 and 83. This is a property we had just taken back from a third party property manager in March of this year. So we just took this one back, and we're in the process of repositioning that property from 78 back up to we'll beat market out here. But the new property manager actually just started this week out there since we took that property back from the third party, and we are now managing that one in-house.
And with Wine and Way, just investors looking at this right now, seeing 78%, which we never been that low, always been higher. But even at 78%, remember, I just mentioned that this is one of the properties we put about 45% down as a payment. I think it was $8 million. I think we put like maybe $4 million. It was $7 million, put 3 or something like that. But this is probably our lowest loan to value in our entire portfolio.
It is. Right? Yeah, we're about 50% LTV on that one. And the difference between 78 and 83, because this is one of our smallest properties, that's like 4 leases.
Yeah.
So the new property manager just starting, they're going to make quick work of that.
I like Henderson her too. I'm excited. Yeah, they're gonna start crushing it on that one.
Yep. Henderson Place, we're at 100%. When we reported this, market in Midlothian is 88. Midlothian Meadows, this is the last property that we just took over at the beginning of last month. We just took over this property in April, and we're going through and repositioning it back now, restabilizing it. This was one where the previous property manager wasn't being entirely truthful with what was actually happening in the property, and we uncovered it. And essentially what was happening is they kept saying we're at 90%, 90%, 92%, things like that on our weekly calls. And then obviously I'm looking at the financials, and like the financials that aren't adding up to 90%. So we terminated them. We took over, and we found that they were people had skipped, and they didn't update the rent rolls to report that those units are now vacant. So we found about 6 units when the days when we took over that were actually vacant, that there were still had people moved in on the rent roll. So it was very timely that we took over that property, and Midlothian is actually going to be the headquarters, so to speak, of Black Sand. That's where the president of the company is going to be housed, and that's where our regional property manager is going to be sitting there as well. So because Midlothian is strategically placed kind of in the center of all of our portfolio, and it has the most offices, that's where we're going to be based out of for Black Sand property management. And they've had 30 days of takeover on that property, and probably another 60 days or so to get it back on track. Obviously, we're going to be working every day to get done sooner, but about 30 to 60 days, we'll be back up in mid-90s over at Midlothian Meadows. Ashton on 287, we're at 96% occupied. Market and Waxahachie's 88. Ennis is a property that we have, or Ensign's a property we have down in Ennis. We're at 87, property's 88. We're actually going to be, I think we're pre-leased a little bit higher at 89 on that property, which as we're recording this on May 1st, we're probably at 89 as of today with those move-ins. So beating market, and that one's actually going in for a refi. So we're beating the market on beating the market on about 4 of our assets. We're right at the market on the rest of them. Biggest gap is Kings Landing, which I explained earlier was an internal property manager that we had to replace. And moving over to the next slide.
So we're now managing all of our properties in DFW, right?
Correct. Yep. So at this time, as of last month, all 8 of our assets in DFW are now in-house, which is a big step for us at Black Sand, and very excited to take control of those assets.
And I was going to make a point, because while you was briefing that, if you again watching this, you say why now for Midlothian Metals. The reason is because when we purchased this asset, it was a HUD, right? So it's a HUD deal. And the requirements for HUD, you have to have a property management company that have HUD certifications or have HUD experience. And that's why we went with, I'm not going to call the name of the company we went with, but that's why we didn't take this property. We had to wait. We had to go through a process. We had to put a package together. As soon as we got that package, we just took over the property come 1 April. So everything, everything in DFW that we own, we manage. And I'll talk more about it a little later.
So this next slide, very similar to the other one, but this shows what the effective rent is. So what our rent that we're actually getting versus our market competition in that submarket. And you can see that Ashton, we're real close to market rate rent within, a couple dollars there. Cottages, we're smoking the market rent. Ensign, we're beating market rent. Henderson, we're beating market rent. And this is King's Landing. This is the one that Dee had a comment for a couple minutes ago. Why it looks like we're not doing great, but actually this is a very good thing for us because King's Landing is a C-class property in a area of Mansfield, Texas, where they are only building A-class product. They're not building any workforce housing whatsoever in Mansfield. We actually met with the city there, and they told us they're not even approving new development of any type of workforce housing. They only want A-class housing, condos, townhomes, things like that. So that's why it looks like there's a big difference there. But that what it's actually showing us is that the pool of C-class product in Mansfield is so small for workforce housing that the people that are in Mansfield that want to be in Mansfield that can't afford the A-class rents, their options are very, very limited to have clean, safe, affordable workforce housing. So we're going to be back up in King's Landing, back up into the 90s and very stabilized here very quickly. But that is something about Mansfield that we've always liked. That's why we bought that asset because during DD we found that the C-class properties there are very, very small pool. All right, Little Creek, we're just about at $50 under market, and Midlothian Meadows, we're actually beating the market. So most of our properties we're at or beating the market on effective rent across our competitors for those submarkets. All right. All right, what this slide is before I hand it over is going to be where DFW fits as far as rent. And our effective rent in DFW is little under $1,500 a month. And it's showing about a 3.5% year over year decline compared to last year. So that's what this is showing, is that the DFW market is still in a declining rent environment, but we're starting to see that turn as we get into this 2026 leasing season that started this month. We're starting to see that turn, and usually the leading indicator of that is concessions start burning off. So we're starting to see our competitors ease up on concessions. We're not having to give away as much concessions in order to get applications in and lease up units. So it's a good sign that the market is starting to recover as the supply hit in 24 and 25 has been absorbed. Because one thing that DFW has that all these other markets don't have is the inflow of population. Texas is the number one recipient in the country of migration, and even with the distress in housing and multifamily and everything like that, the people haven't stopped coming into Texas. With everything going on, 30,000 people move to DFW every year. So even though there's a strain on the financials of this business, the population is still growing. It hasn't stopped, hasn't let up at all. What are also some of the headwinds we have is with the population inflow is because of the interest rates and the lending environment, with all these lenders taking huge losses on their books, they've tightened up a lot on lending on future deals. So the supply pipeline going into 26, 27, 28 is like a cliff. Huge drop in net new deliveries in the DFW market, from 26, 27, 28. There's very few new starts. There's very few projected deliveries compared to previous years where we were seeing 30, 40,000 units delivered every single year. I think we're projected to have like 15 or 16,000 delivered this year. However, the population still every year, 30, 40,000 people moving in.
Okay. Is that like 30 to 40,000 people a month or a year? I don't even know.
I think it's more. DFW, I believe it was it's over 100,000 that came in DFW 2025.
Wow. So there's not a lot of new apartments coming out on the market. So eventually what's going to happen is what you're saying is that rents are going to be going up, most likely, right?
Yep.
Correct. What we'll see first is, we'll see occupancies go up. Once occupancy is stabilized, then the concessions will start burning off. And that's a good leading indicator is that the concessions start burning off. And then from there, once the concessions burn off, then the effective rents are going to start going up. So that's what we're watching closely. We do market surveys every day. And with AI now integrated, we can do it almost instantaneously to see what's going on in the market.
Good news for us.
Yep.
And for investors.
Yep.
All right.
Yep. Just piggyback. I did double check my notes because just give y'all a little bit. Last week, Vince and I was, like he mentioned, was with all our brokers. We love to go see our brokers at least twice a year in person. That's one of the things was about, building relationships and things like that. And I was just looking at my notes over here. DFW had about 150 to 180,000 people move into DFW. If you're watching this, there's no better market to be in right now. The brokers know it. We know it. DFW is the number one, number two market, depending on what you're reading. So it can be a better place. I would tell you that when you're looking at the state of Texas as well, when you're looking at Texas and you're looking at Dallas, Austin, San Antonio, and Houston, I would tell you that Houston and Austin is getting crushed. It's getting crushed. And DFW, and the reason we like DFW because there's so many. If you ever in DFW, driving up and down the highway, you see so many of those blue chips and S&P 500 companies to your left and right. Their headquarters all there, and they're still moving there. So DFW is a great market, and we like DFW. But I did want to look at my notes, but it's 150, 180,000 people that are moving into the DFW.
That's a lot.
Yeah. Yeah. All right. So what I would like to talk about, 2020, Tri-City was a more syndication, and right now as we speak, we fully is a vertical integrated company. One of the things that we move in, we focus being more as a family office, where that we bringing everything in-house so we can control. Like I said earlier, there's no one that's going to take better control, all right, than your property. You really think that the third party is going to carry out? I'll tell you, every third party that we work for, we had to fire them, either they were stealing money, just overspending, or things like that. So, and all of us on this call are owners of Black Sand, and we're, we lose. I promise you this: every day, every night, our number one focus is to protect our investment and to protect and do all we can for our investors, and we don't take that lightly. And so what does that mean for vertical integration? Number one, like I said, we have an own Black Sand Property Management, which is all in-house. We built everything. We have absolutely no third parties within Black Sands. We right now are building our teams for our construction and renovation. Again, there's going to be lots of opportunity for these value-add distressed assets. And we want to make sure that we control everything from A to Z. because we know if we have control, we're going to do a better job because we just, all of our partners is just hands-on, and just want to do great by all means. Supply. One of the things that I did was last month, I went to China and I was there for 2 weeks, and we have everything in place where that we're going to cut out the middleman. And once we are able to cut out the middleman, that means that's more savings, and more savings mean higher returns. And also it better position us. Everything that I'm talking about when we come in house, it better position us because we can do things cheaper. We can control time, projects, and all those things as well. We also brought in our marketing and accounting teams. We have full teams that's doing all of our marketing, all of our accounting. So all of those things are all in-house across all 8 properties. And also, just transparent reporting, lenders reporting. One of the biggest things is that all of our assets, except for 2, like I mentioned, are all they're all agency. So we have some type of reporting compliance. So we are always on that too as well. Next slide. Okay. All right. So we talked about this a little, so I'm not going to dive deep. And Jim, you can jump in or Vince. So what we're doing last year, last year we purchased 3 A-class properties. All right. And guess what? All 3 of those A-class properties we purchased, target discount is what? 30%. And that's what we got, about 30% discount for the last cost basis. Again, that 30% represents the equity from investors' capital being erased. So 2 of those properties was heavily discounted. We have purchased, one of the properties Vince mentioned was Ensign. Just give you some clarity on that. Product cost to build on that was $180,000. They wanted to sell about $150,000. We ended up closing that deal back in August for $100,000 and around $20,000 a door. And that property was brand new construction. And that was from the developer. So there was no brokers involved. So it was able to save on that as well. But those are the type of properties. When we talk about long-term assets, when we talk about long-term holds, those are the type of properties that we want to hold. Some of you may hear them called trophy properties, or nice properties, nice bones, and they're the last. But what we're focusing in, as far as Black Sands and Tri-City, we got 2 lanes that we're focusing on. Lane number 1 is A-class, distressed A-class. And that's what we purchased last year. Now, that was at 30% discount. And today, those same A-class are still being 30%. We actually seeing more volume of the Class A products that are discounted at 30%. But one of the opportunities that we really like is what we are really great at, and that are the value add Class C assets. And Class C assets that we are seeing is currently anywhere from 50 to 70%. Vince and I was working on a deal back from December, been working directly with the lender through a broker relationship that we have. And the asset came to us and said, listen, the lender just want to walk away from, they just want $18 million from the deal. That was at 18 million. That's the note. Months go by. We taking calls every single Friday with this lender. They went down from $18 million from $15 million, all the way from $15 million to $11 million. All right. All the way from 11. And we walked away from the deal still. So other things happening, but they were still willing to go down just a little bit more. All right. That deal last close transacted for over about $35 million was what the seller paid. And you go from $35 million all the way down $11 million. Those are the type of some of the distress. That's right. There was a little bit more distress, something that we didn't want to kind of roll our arms up, because there's better. What we're doing is we're saying there's better property, REO, bank-owned property, than some of all this distress. And there's going to be plenty. When what Vince was talking about is now coming, and it's going to be more to come. And we want to be able to cherry pick. I mean, cherry pick. And what I mean by that is that when we was out last week in Dallas, we went around to all our brokers. We had in fact, got my list right here, about 20 properties, and we cherry picked 10 properties. every 10 property from class A, B, and C was discount from 30% to 70%. And what we would like to do is we will like to continue to focus on distressed class C assets, but we focus on class C assets that have a AMI or medium income of 60,000 or better, and that have good bones, good position, and not so much as a heavy lift, like a super heavy lift. So that's what we're doing as well. So the vintage, I'm not going to say 70s. We don't buy 70s
That's
properties.
a typo.
Yeah, it's typo. We don't buy 70s. And the reason we don't buy 70s is because, cast iron, and I talk a little bit about that, but we do like to see mid 80s due to, PVC piping, electrical, and lead paint and things like that. But right now, we are seeing that Class C assets is when we talk about bang for your buck. Our goal would be, acquire these properties at a discount and hold at a short period of time when the market is ready. We'll still go in and make sure we get good debt on it, and be ready to flip these properties in 2 to 3 years, more like maybe 3 years, and be able to roll that money from that deal into a legacy, a Class A. All right, but we know that if you just like stocks, bonds, we have small cap, we have medium cap, we have large cap. Well, your large cap stock would be considered the lane one that you see in the stress. That's your Apple and Facebook and your Teslas. Where that over here, what we're seeing is more like an opportunity for small cap. And we know when the market goes down, small cap flies. So that's currently what we're doing, what we're looking at.
That's incredible. And you think in years to come that us buying these properties at a 50% discount, 60, 70% discount, these are going to be the best opportunities, right? In 3 to 5 years, because, fingers crossed, interest rates go down. The market comes around, our occupancy goes up. The amount of rent people are paying, it goes up. We're going to be sitting in a super good position on properties we're picking up today, right?
One of the phrases that kept getting discussed here locally from the brokers and lenders and stuff like that is a generational cost basis reset. Is this reset in these prices 30%, 50%, 60%, all the way up to 70% is like none of them have ever seen anything like this. This is like a once in a generation cost basis reset with what we're seeing on the equity side. But getting at these prices, having the market stabilize, having that supply dry up, because there's not a whole lot of future builds getting built over the next couple of years, and then just regular macro inflation, because government's still going to print money, they're not going to stop, so inflation's still going to happen, and these are going to recover in 3, 4, 5 years. Some of these legacy holds, these A class, we're going to plan on holding up to 10 years. It's going to be a very, very good position for us.
It's like buying Google at a 60% discount, and then somebody looking at it and saying, "Hey, do you think in 3 years Google's going to be worth more money?"
Yeah.
So yeah, I'm feeling pretty good about this right now.
Yeah, absolutely.
So this is one that
right.
You want to hit this one, the auction thing?
Yeah. I can give a little bit about it, but as far as we don't do really auctions, I think we did one auction, right, Vince? I think that was Wilmington, North Carolina. But right now, in the environment that we currently at, in today's environment, like special servicers are like increasingly preferring like doing an auction over trying to negotiate a sale with like a broker or whatever. And their goal is simple. They're trying to protect the process and avoid selecting buyers who cannot close. This keep them from pretty much losing their job, because they are most of all of them are obviously they 9-to-5 work, W-2 employees. This is why they work with auction firms. They are proven, and as far as who can do what, they make sure that when there's an auction, there's no retrading. That's one of the last minute retrades. Again, they're trying to get the deal closed. The structure is designed to eliminate weak buyers really quickly. And the way they do that is, 10% earnest money, staring at close in 30 days. Reserve prices are usually not disclosed before the auction, and you must show proof of funds, liquidity verifications, and the operational track, which we have. So this market is no longer about who can submit like the highest offer or LOI. It's more so like as far as like certain to close. Vince.
Yep. No, that's exactly it. Is that the sentiment on the auctions of going the auction route is they just don't want to get retraded. They don't want to go back to their bosses and have to deal with retrades and repricing and stuff like that. So they're choosing to go with sponsors that can close, that have good track records, histories of not retrading or renegotiating. And one auctions is a method that they're also looking to do that.
Yep. And this slide right here is what we will not buy. So it's kind of, this right here is the opposite of our buy box, if that makes sense. So any properties that's under 100 units, we would not buy those simply because it make it hard for payroll. Also 1970s, you heard Vince say there was a typo. We don't buy 70s because of, just cast iron piping, old bones, electrical, lead paint, and all those things too as well. Just 1970s, that's 60 years ago, I believe. Sub like 60K AMI of median income. Now, our sweet spot, what we always look for is 80,000. We like to see $80,000+ when we're looking at A class, B class assets. Also C class, but for C class, we readjusted it because we get a little bit more opportunity, and at the 60,000 for C class is kind of like what we're looking for. So we're looking at those two lanes. We want to be kind of somewhere between that mid 60, but our sweet spot is $80,000+ median income. And I would tell you that as far as our buy box, most of our portfolio is somewhere between $90,000+ median income, and we are located like in between DFW and Dallas. So Midlothian, Waxahachie, where population growth is like 20%. There's two places where it's got a 2 and higher, and that's north of the toll gate, so you're going to Plano, Frisco, all the way up to Salino, all those areas 20+%. But when you're looking at everywhere else on the map, no matter where you look at, there's a population growth. Great for the market. It's always growing. But when you're looking at the southern part where we are located at, we're 30% population growth, which is really cool. We don't looking at new construction. We're not looking at new construction that's costing more than $200,000 a door. Like I said, the cost to build right now is probably somewhere around 240, 260, where cap rates are at. So that's why that's where Vince was talking. You're not seeing the supply. We only have about 15 to 16,000 units coming online, and most of those units coming online, they was probably already approved or already building, during the COVID time and all that. So right now there's going to be a housing shortage, if anything. That's what's going to happen when and it was so many properties in Midlothian when we went to the city, went to the economic development, went to the, all those places, and everyone is telling, oh, we about to build all of these houses, all of these apartments, like 20,000 apartments going to come online. And guess what? Everything have stopped pretty much. So we have seen that in the past 2 years here now. LIHTC, which that's your low income house tax credit. So that's more so your affordable housing. We're not looking at those properties. We have 3 or 4 properties in the past that we did really well with, but we right now are don't want to restrict ourselves with the value add upside, being able to not be able to increase our rent with market. Sponsors retrade. This is a no-go. We're not looking to work with sponsors who retrade it. We only did one retrade. I'll talk a little later. But one of the things about being in this market, in DFW, just the standard business and best practice terms is that when you go up on the contract, you want to make sure that you close, you do it well, you be a good stewardess, you're not retrading, and that's going to go really well because when we close on deals, everyone, I get my phone light up from different brokers. I heard you close on a deal, and you want to have a good name. And DFW, even though it's a large market, one of the things is that our name is really good. Tri-City, all of us, Jim, Vince, myself, they have great things to say about us because we always close. We close on time. Overbuilt areas, just stand away from those areas that are overbuilt areas. So again, Vince already hit on that as well. Anyone got any?
Oh, that's good. That makes total sense. So we're you're picking up great deals in great areas where household income's high. Probably, I'm assuming schools are good, job growth is good, all that kind of stuff. So that makes total sense to me.
Yeah. And again, this is like what's happening. There's two paths, right? You have more the syndication model. What's happening. A lot of the funds in the past 36 months model. One is the syndication model, which is normally a 3-year hold or a 5-year hold. And we already done hit this already, but a lot of investors are obviously losing their capital. The clock has stopped. A lot of bridge that's out there. We're more going to a different model. Again, that family office math. We're talking about more so long holds, horizon, being patient, buying these legacy properties, being able to get in here and even buy the distressed assets and for our investors. We're buying these assets, for us and our investors, for we all can make great money and be able to move this money over and get into more of the long-term legacy properties. So that's what we're currently focused on right now. A lot of, if you see right here, say refinance is a tool, not a structural requirement. This is a tool. We don't, it's not a requirement. We're not, we want to position ourselves and use these tools when it's, when we can. Our last property, I believe we have out there in the flats, we was able to refinance and return. A lot of you, I know a lot of y'all on this call, probably, or some of you on this call invested in the flats. And we was able to use that tool when it was needed, and we was able to return capital back. And we still is currently holding that property with great debt. And I don't know if Vince's going to give you an update, but I'll let him talk. But he's looking to sell that property right now if we are able to do that. But yeah, so that's what we're looking for here. You got anything to add here, Vince or Jim?
Jim, you got anything?
No, I think that's you said it all. It's like I said, future is looking really good. So I love the vertically integrated path that we're on, and also how conservative we are, putting lots of money down, lots of money for upgrades and buying right, basically, and not putting any of our investors in any jeopardy. And I think you said it before, but we've never lost any money for investors. There's never been a capital call. So we're in a good position for success here. And as we continue to grow, it seems like we're going to have when you scale, you're going to have better margins with scale, which is super exciting too.
Yep. And one of the things with the, switching from just a syndication mindset of having to transact all the time versus the family office mindset of longer term holds, lower leverage, being patient, choosing the best deals, financing them right. Like we mentioned earlier, long-term fixed rate, low leverage debt, allows us to be patient and not have to be reactive when it comes to capital events and things like that. Like, oh, we have to sell, or oh, we have to refinance because of the way we structure deals as we, evolved as a company over the last 6 years. One of the things with the family office mindset as well is, one of the brokers we met with a few months ago that we've actually done one of our biggest deals with. He was saying him and the top brokers in his firm there were saying that the phone's ringing from people they haven't talked to in 10 years.
10 years,
yeah. That these family offices, he said that some of these family offices are controlling like $300 to $500 million in capital that have been sitting on the sidelines since 2017, 2016, waiting for moments like this, that they've just been sitting. They've been very patient. And now these family offices are calling and seeing what assets are distressed. They're picking the best ones, mainly driven by location. Which properties have the best AMI or median income locations. Things like schools, crime, AMI, and they're cherry picking these distressed assets in the best locations, and they're coming with virtually unlimited capital, and doing the same playbook as we are: low leverage, long-term fixed rate debt, buying down at 40-50%, buying down on the principal, and they're going to put them into the family portfolio, and then they're going to be around for the next 2 or 3 years, and then they're going to disappear again. And I thought that was very interesting and very encouraging that we are on the right path for where we want our company to go. Is that these people that these families that have hundreds of millions of dollars of capital they're controlling are waking up, and they're in the market, and that's who we're competing with for these distressed assets, where most of the syndicators have been now washed out. They had their equity positions, if they're currently holding, like we talked about earlier, have been wiped out, and that's affecting their ability to buy new properties because they can't raise the capital. They've destroyed their investor base. So a lot of the syndicators are getting wiped out of the market, and they're being, essentially scooped up by the firms that are ready to take advantage of the market, like us at Tri-City, and these family office and PE firms that have just been waiting on the sidelines for the last 10 years or so for a moment like this, and just being very patient.
Which this slide right here is simple. A lot of what Vince just mentioned. People cannot raise capital right now. The LP, which is that limited partner, all these syndicators who built their book of business have pretty much lost a lot of their investors' capital. And right now, we're seeing capital being reconcentrated, and what they're looking for proven groups with track records. They're looking for groups right now, looking around because they know they have lost money. So many investors. Again, we're talking about 30%. I would tell you, I have seen and just been talking with brokers. I'm on the phones with brokers every day, and it's really sad. But I would tell you that the limited partners, the LPs, the listeners to this call are going to be looking for other groups, and what they're looking for groups with proven track records, groups who have not picked up the phone and say, "Hey, we need a capital call." Which Jim mentioned, there's have not been any capital calls within Tri-City. We haven't lost any money as well. None of our investors' money. We are continuing to weather this storm, operate and make sure that we control our assets. And right now, the buyer side credibility, everything is being repriced. So there's new cost bases that are being set here, where again things that was 150, we're seeing being set around 70,000. So C class on average, what we're seeing right now is somewhere between $70,000 to $80,000, and that's just a regular C class asset. And if you want to, and the only one that we really seen, we may have seen one or two that was 105,000. That because it's located great, AMI is great, meaning the median income is in a great area, and it's cash flowing. And a lot of these properties too, I think it's super important to say, a lot of properties, even we just got off the phone today, Vince and I, we had a buyer's seller's interview, and we have a property which is performing they're on target to be around 92%, 91%. The sellers are selling. Is distressed. He probably paid $135,000. We right now with Best and Final had a conversation at $95,000 a door. So you're looking at an $8-9 million discount from what he paid for it. But guess what? The property is 91% cash flowing, making money. Why is he selling? His time is up. The loan has matured. Let's go back to he's been forced to sell. He would not be selling right now if he didn't have to sell. Again, the property is making money. The property is occupied about 90%. And if we win this deal, which I believe we got a really good chance because we transacted with the seller just a few months ago. I believe November is when we purchased the cottage. It's the same seller. And I would tell you what he told us, everything that we talk about in this call. He said, guys, I want y'all to be the one who win this property. I want to give it to y'all. Right now, y'all the lowest as far as price per door. But I'm going to send you the rent roll over on Monday, and we're going to give you an opportunity. And there's two other groups who's higher than you, but I don't care about those two groups. I transacted. So what is the seller looking for? Certainty to close, and because we have a proven track record that we have closed with him. And I think the last raise that we raised was $12 million. And this one right here is a much lower raise too. Well, I wouldn't say much lower. It's probably going to be around $10 million. But I just want to kind of bring that up.
Property's twice as big, though.
Yeah, property. Yes, yeah. This property is twice as big. Yeah.
Yeah.
All right. Anything there? Okay. All right. So I'll continue to wrap this up. This slide right here just continue to tell what we're doing. Right now, our focus is we know we have about 24 months. It's not like all these properties is going to rain, like hurry up and go, go, go. No, we're taking our time and we are cherry picking deals where I got a whole list of deals that all discounted. And then we know there's going to be opportunity all the way throughout the next 12 months and the next 12 months after that. And the reason we know because we are talking with the lenders, we're talking with the brokers. And what's happening is that all these properties is not going to hit the market all at once. All right. They said it's going to take up anywhere from 18 months to 24 months for the distress. It's so much distress assets going to hit the market. And we want to be in position, Tri-City, and we want to be in position to take advantage of our relationships, take advantage of bad management, take advantage of these distressed assets, or where they bank on auction or whatever. We want to just make sure that we are positioning ourselves for the next 24 months. And I was up here doing the math, right? $35 million would buy us about $100 million of assets. And that is at an LTV. If we pick up $100 million of assets, if you go back and look at the last cost basis, that's probably just like buying $150 million. All right. So the discount, and I was thinking about it, I'm like, the discount we're getting is like getting a free property almost, if you look at it, right? So we believe, we have seen people that come into the market. I talked to my mentor who's in as well, and he told me, he said, D, you did really well for yourself, but your true wealth is going to be made within the next 10 years. You could not be at your age right now, you're in the best position because you're going to get an opportunity to take advantage of this market cycle.
Couldn't have said it better.
All right. So it's me.
No, you're good.
Okay. So and you can take the next one. Pretty much right here, there's only 3 ways to read this cycle, and I guess and this is my question for investors that's currently watching this. There's only 3 ways. I know where I'm at. I've been investing for a real long time. I've been in market cycles, stock market cycles, real estate cycles, and I know opportunity. All right. So you're going to either read this as, hey, this is an opportunity. Right here said disciplined operators ride the next 24 to 36 months. This is requires operational capability, capital, source dealing. This is where the real opportunity is at. The market is currently being reset. This is the opportunity. It's time for it right here. Or you're going to be a realist. All right. Meaning that, again, you don't have to, what we're going to do is, as far as, Tri-City, we're going to position ourselves so that we can be able to purchase, not just in over the next 6 months or 12 months. We want to be able to take advantage and continue to invest over the next 24 months. All right. Because after the 24 months, guess what's going to happen? All right. You're going to be over here, number 3, waiting on the sideline, waiting for clarity, but it's going to be too late. It's going to be too late. So the question is, where are investors? Are they feel like, hey, is this an opportunity, or should I wait, or I'm going to wait and miss the ride? Vince, you got something? Sorry about it.
Nope. Yeah, I would say we're going to be between 1 and 2 up here. This, we're absolutely going to take advantage of this generational reset. Like you said, if we lock in the next 2 years, it's going to set us up for the next, really the rest of our lives. Really is how I see it. Just the generational reset on that. Yep. Probably double, triple our portfolio over the next 2 to 3 years. And then between 1 and 2, like I said, we're going to be very patient, calculated, and cherry pick the best deals, best locations that match, how we underwrite properties, how we operate, and really not just scoop up everything. We're going to scoop up the best things as we grow, because there's going to be plenty of opportunities, and we're definitely not going to be the ones sitting on the sidelines. I know many people that are, smarter than me, I guess, but they spent, the last 10 years sitting on the sidelines, waiting, and they're going to continue to wait. They don't take action. And the only way you're going to know when the bottom is looking back at it and be like, that was the bottom. I should have bought. For those that do stock markets, you know exactly what I'm talking about. Is when you're in the downturn, and there's the blood in the streets analogy. Everybody's freaking out. Everybody wants to, get out. And then the smart money is going in, buying the blood in the streets, scooping up those, getting in at those great cost bases, because they're moving with good data, and they're patient, and they know when to strike. They take action. And that's what we're doing. We're not going to be the ones sitting on the sidelines, and they're going to miss this and look back, 5 years from now saying, oh, we should have bought as many properties as we could during that downturn. We've been in this market now for 5 years. So we've seen, the up, the down, with the softwares and data that Black Sand has, gives us an insider's look. Like most of our competitors don't self-manage. So we get a daily pulse on what's happening in the market, occupancies, rents, what people's sentiments are in the market. And that gives us a competitive advantage that most of our competitors will not have, is that operational kind of ear to the ground knowledge that we have through Black Sand.
Yeah. Something I don't think we talk enough about too is our team and our culture a little bit. And I don't think people realize, if anybody's ever subscribed to Traction or EOS, Entrepreneurial Operating System, we've got a plan. We've got a plan for the next 10 years, all the way down to one day. And the team that we have and the culture that we have is we run this business with integrity, extreme ownership, where all the people on our team are looking at this like they're an owner, a sense of community, not just for our team, but for our residents in-house. How do you feel at the property? It's a feeling of really, this is a home, not an apartment. Really a growth mindset, knowing that we're going to keep growing, better rental rates, better occupancy, better properties as well. And really resilience, as well as our last core value in our culture, is we're never giving up. You're surrounded here with a group of people, a lot of them in the military, which, thanks again, you guys, for your service. I always really want to say that to you, but people who will never give up, and they're better than anybody else out there. So I'm proud to have these people on our team, and our internal team, and our managers are the best in the business. And I can't say enough about how happy and how privileged I am to work with this kind of a group of people.
Yeah.
How do we follow that?
Good closing.
That was good. That was great. Thank you, Jim.
Thanks.
So yeah, we can close this out. This investor update of where the DFW market is, how Black Sand is postured through it, how we're weathering the storm. We're doing a great job, either at or above market, and continuing to get better every day against market benchmarks. And Dee went over what our next 24 months acquisition is going to look like, what the deals we're looking for, and locking in those cost bases that are just really unheard of. From people that have been buying in this market for 40 plus years, haven't seen what we're seeing today. So do you want to close out?
No, only thing I say, if you're watching this, if you got questions and you want to, schedule a call, please reach out, to whoever your sponsor is, whether it's Jim or Vince or one of my investors. If you have other people that may, they may know someone that has lost their capital in another deal, or they have capital in the sideline, or even having capital in their retirement, we have experts on our team to help show them how to invest capital. There's going to be opportunity, and we'll love to have you continue to invest along next to us. Thank you.
Are you looking to become a passive or active investor in multifamily real estate? Or maybe you're at the point where you ran out of cash for not having any systems and processes or the right resources in place. Investing in real estate is an excellent way to start building multiple streams of income, but it can become challenging if you fail to overlook market analysis like selecting the right location, researching the current market trends, and finding the right property management company. You don't have to have a formal education in business or real estate to reach the success you desire. You just need a proven blueprint. Hey, I'm Duran Bethea, and I've been an entrepreneur and an investor since 2003. I started investing at the age of 20 when I was active duty military as a full-time soldier, and now I've created over $100 million in business and real estate assets, and currently host Hawaii's largest yearly business and real estate conference. If you do not know where to start, or maybe your investment properties are not profitable, you're not alone. That's why I created the Business and Real Estate Blueprint, a comprehensive course with insights, practical strategies, and actionable tools that can help you build and grow a real estate portfolio. If you're ready to start building generational wealth, click here to learn more.